All right, class. Welcome to part 2 of our discussion of Chapter 4, Exclusions from Income. And we have here the idea of compensation for physical injury and sickness, not mental or emotional, but physical injury and sickness. So this includes workers' compensation. It also includes medical expenses and compensatory payments if they're connected to a physical injury or sickness claim. So, however, if you get reimbursed for things that you didn't spend, that's taxable. More importantly, that's seldom going to happen. Punitive damages, even with a physical injury, are included. So punitive damages are not what you lost, but those are what the court awards to punish the person who hurt you or whatever. And doesn't really matter what the punitive damages were for, and you receive them, they are taxable. And non-physical injuries, even if compensatory, the exception to this that's not mentioned here is if you have to receive actual medical care. So if you actually received counseling or some type of intervention for your non-physical injury, that medical care would be excluded, but all the rest of the payments in the lawsuit or such would be included. So that's how it works for injury and sickness. Roth IRAs, creating the tax law about 10 or 15 years ago. Maximum contribution you see there, but you can't even make one unless you fit the criteria. Notice that there is a threshold which if your income is too high, you are not allowed to make a Roth IRA contribution. Also notice that there's a $1,000 extra if you're over 50. So you need to know and remember that this Roth IRA is subject to income. So example of how this works out, just like some of our other phase-out ranges, we take the difference between how much we went over the threshold, divided by the phase-out range, and then multiply it by the limit. That gives us the amount that is reduced, we subtract it, and then we can always round to the nearest 10 in the IRA situation. That's not always the case, but in this case it is. Another example with someone who is married filing jointly. Notice the amount is far higher, but the phase-out range is only 10,000. So it's actually phases out faster than it does for those that are single. That's different than most cases. She's over 50 too, 50, so it's the maximum that she can put in is 6,500. So you see how that plays out. So Roth IRAs have some special rules about pulling money out. You can do that as long as you wait 5 years. And the money coming out of a Roth IRA is not included in income. It's tax-free and penalty-free as long as it fits these criteria. Education savings plans are very similar to Roth IRAs in that they are not deductible when they go in. The limit is $2,000 per beneficiary. So if you have 6 kids, you can put $2,000 in for each kid if you like. If you put too much in, there's an actual penalty for putting it in. Another example is a 529 plan that's actually much broader, much more money you can put into a 529 plan. That's become the favored way to save for education. But in both cases, what happens is the money that is earned inside the plan is not included in income, and if you pull it out and use it for education, it is not included in income. That's the exclusion. So if amount left in the plan once it turns 30 can either be rolled over to another beneficiary, which is not mentioned here, or if you pull it out, it's 10% penalty. Okay, and it goes back. The money goes back to the giver, not to the beneficiary. So you don't get to pull it out and just take a vacation if you don't use it for education. Brand new type of plan, Able Savings Plan. You notice those, they are very specific in their amounts and who they are apply to. Age disabled folks up to the age of 26. So not going to come across these very often, and again, they're new, and so there's not very widespread. They haven't really gotten traction out there. Discharge of debt. Someone gets their debt forgiven. That is normally income, and it really sometimes really surprises people that they receive income if, say, for instance, they talk their credit card company into forgiving part of their credit card bill. The only way that that is not income is if they are bankrupt or insolvent. So you would have to prove that that was the case at the time that debt was forgiven, which is not unusual that that would be the case, but it means that well, there's a lot more to prove in that situation. So you're probably going to have to do that if you want that income not to be included in your income. So now we turn to deductions for AGI. These are all listed at the bottom of Form 1040. Each of them have their own specific rules. Now, just a couple of things before we get into this. Notice this first one. Business expenses of reservists, performing artists, and fee-based government. That's very narrow. These are Army reservists, Navy reserve, those that serving in the reserves, performing artists, and fee-based government. That's the only ones that get to deduct their business expenses on the 1040. The rest of us, it goes on Schedule A as an itemized deduction. We'll talk about it in Chapter 6. So don't get those mixed up. It sounds like a great deal. You see it right there on the 1040, but it is only for these very specific folks. This is only for K through 12 teachers who buy supplies for their use in their classroom up to $250. Hardly, it's not even a big deal, but so you see that and you go, oh wow, that's a great deal, but that's very specific as well. The idea was teachers were always buying stuff because the school couldn't pay for them, and they got a deduction for that. All right? So we're going to have slides about some of these other ones, as well as these situations: health insurance premiums, penalty, alimony. We talked about alimony in Chapter 3, IRA deductions, student loan, and domestic production. So health savings account. This is a high deductible plan that you can contribute to as long as you put that into your savings account and use it for medical expenses. Then you are not including it in income. So if you pull it out for other reasons, then you pay a penalty as well as everyday income. So notice there's a maximum, and you have to have a high deductible plan. Typically, this couples with your employer providing a high deductible plan or something of that nature. Moving expenses. Notice that it is transportation and lodging for you and your household members, as well as getting all the stuff from one place to the other. But it has to be for work. And notice that this mileage rate is only 17 cents, which is pretty low for how much it actually costs to operate your car. Notice that it has to be 50 miles closer, okay, to your new work location than your old residence. So when I moved across town in 2006, nothing was deductible because I didn't get any closer from work. In fact, I got further away from work. So it was simply to get to a house that had more room for the family. So this wouldn't apply. So moving expenses to get closer to work or to cut down your commute. You also have to work full time. There's a lot of exceptions to this if you happen to get fired from a new job, but technically you don't know for sure for a whole year, which seems very impractical. You move someplace, in theory, you could have your deduction for moving disallowed based on not working that full time. So the tax law has some exceptions about being unemployed and whether you're seeking for work and things like that. So we're going to generally make the assumption that they qualify based on that time frame. Here's how you would calculate a scenario. Notice that the meals are one thing that is never deductible for moving. Cost of eating on your way. Reported on Form 3903, you take your amounts, add them up, subtract what your employer reimburses you, and the excess goes to schedule onto your 1040. All right, self-employment. We'll talk a lot more about this in Chapter 7, how to calculate this, but half of it is a deduction for AGI. These contributions will also be Chapter 7 retirement plans. So IRA type of situations, but with self-employed folks. All right, those who have self-employment income, they have their own business, they can deduct all of their health insurance here and not as a medical expense that we'll learn about in Chapter 5. But notice the limits, net profit from the business. So the business has got to make some money, or you can't deduct any of your health care costs, at least as a for AGI deduction on the 1040. This is very minor. You pay a penalty if you take out your CD early. You buy an 18-month CD and you take it out before 18 months, there'll be a penalty. That's deductible here. Alimony is already discussed. And then the complicating factor of the traditional IRA. Notice there's a maximum of $5,500 earned income. If you're over 50, you can get extra 1,000, so up to $6,500. If they're earned income, so it used to be that only the working spouse or the one with income could make a contribution. Now, even if one of them is a full-time student or doesn't have income, they can make a contribution for both, even as long as their income exceeds the amount contributed. However, if there's an active participant, so if you don't have a plan at work, a retirement plan at work, then you're good to go with your IRA, no matter what your income is. However, if you're an active participant at work, then the amount you can deduct, you can still put money into your IRA, but the amount you can deduct is limited. So here's how this works. For the person who actually participates at work, so we assume that two spouses, okay? If you're single, obviously that doesn't, this is your limit right here, okay? It phases out, the ability to deduct it phases out there, money filing jointly, maybe filing separately, living apart, and separately with the spouse. Notice how that's penalized, okay? But if you are married filing jointly, this only applies to the one who is actually participating at work. The other spouse that doesn't participate at work, now if you both participate at work, then this applies to both of you. But if the other spouse doesn't, then their phase out is much higher, all right, because they don't have another way to save for retirement. So here's an example. Matt is an active participant, so he uses the first phase out range and phases out $1,300 out of the $6,500. Mitzi is not an active participant. Her threshold is all the way up to 186, and they're not that far, so she can deduct all $5,500. Okay. You don't have to pay generally, pulling money out of an IRA is taxable, including your income, and you will be penalized if you pay it out, pull it out early unless you fit these criteria. Student loan interest phases out very quickly, but $2,500 on interest, 65 to 80,000, and the same way as we talked about with these other phase outs, you figure out what your AGI is compared to the bottom number of the phase out range, and then divide by the phase out range. And then this one is going away, but for 2017 it still exists. And for those who are self-employed, if they make stuff in the United States, they can deduct it for AGI. Usually this is a business deduction and doesn't affect the 1040.